Hello and welcome to Market Cafe with me, Ankita Saxena. It is a fresh day of trades. But first, before we tell you all the trade setup for the morning, let's take you through how the global markets fared. Now, stocks in US inched higher on Monday as Wall Street braced for quarterly reports from some of the biggest companies in the world. Now, the Dow Jones Industrial Average traded 76 points higher, its highest closing levels in 2023. The S&P 500 climbed 0.3%, while the Nasdaq Composite advanced 0.9% in trade. The shares of tech giant Apple added 1.7%, while Tesla climbed 3.2% in trade. Now, shares of JP Morgan Chase also ticked up 2.4%. The second quarter earnings season gains steam this week with results from big financial institutions such as Bank of America. We have Morgan Stanley and Golman Sachs that will be coming out with their quarterly reports. Results are also due for United Airlines, Las Vegas Sands, and technology giants Tesla and Netflix. So that's something that we will be tracking very closely. Let's look at how the crude is really working there. Crude prices are edging slightly higher in early trade today. After sinking in the previous session on a weaker than expected Chinese economic growth, as investors are eyeing a possible tightening of the US crude supplies. And Brent crude currently is trading at $78.8 a barrel, whereas WTI is currently at $74.48 a barrel. So that's where the crude is at. Now let's look at what are the events that we need to watch out for in today's session. On the global front, we have major earnings coming in today. We have BOA and Morgan Stanley that will be reporting their quarter one earnings. Back home for the Nifty companies, we have IndusInd Bank that will be reporting its quarter earning today. On the 20th of July, we have Infosys and HUL that will be reporting their quarter earnings. On the 21st of July, we have HDFC Life, Ultratech Cement, JSW Steel and RIL that will be reporting their quarter one earnings. Also, besides the Nifty companies, we have ICICI Lombard, ICICI Prudential, Mahindra CIE, L&T Tech and Polycab that will be reporting their quarterly numbers. So that's the roundup of all the events that we will be tracking very closely. And well, moving on then, big news. We are very optimistic. There with some optimistic news that we are tracking this morning. Chances of recession are really waning according to the banking giant Goldman Sachs. Now, Goldman Sachs sees a 20% chance that US economy will fall into a recession over the next 12 months. And the figure is down from their earlier 25% forecast. Goldman Sachs believes a low unemployment, strong consumer sentiment augur well for the economy.
Right, and global auto major Ford Motors has gone ahead and slashed prices for its electric F-150 Lightning pickup amid efforts to boost production. Company said that prices for some of the least expensive versions of the Lightning would fall by nearly $10,000 and prices for all other versions will fall by $6,000.
An ace investor Warren Buffett has offloaded a major portion of his stake in Activision Blizzard as Microsoft's deal to buy the video game giant edged closer to completion. Warren Buffett has sold as much as 70% of his investment in Activision. In a regulatory filing, Berkshire said it owned about 14.7 million shares or 1.9% worth $1.24 billion on June 30th, down from 49.4 million shares or 6.3% in March.
Well, and shifting focus then, India likely to be a major driver of Apple's 5-year top-line growth. This is according to Morgan Stanley. Morgan Stanley believes India's booming economy and Apple's investment trajectory in the country will drive growth for the company. The note also reflected a new India-driven price target increase from $190 to $220, with a bull case valuation increase to $270.
And BlackRock names Amin Nasir, CEO of Saudi Aramco, to join the board of asset managers' board of directors. Meanwhile, BlackRock said this move reflects the firm's emphasis on Middle East as a part of the long-term strategy.
Well, and the deal allowing Ukraine to safely export grain via the Black Sea has officially expired after Russia pulled out of the crucial agreement, reigniting fears about global food security, with analysts describing the initiative's demise as both an inevitable setback and a blow to markets.
And world's second largest economy, China, has witnessed a lower than expected growth in the second quarter. Now, Chinese economy grew at 6.3% at annual pace in the month of April to June quarter in the current fiscal year. Now, the 6.3% GDP print for the second quarter marked a 0.8% pace of growth from the first quarter. In fact, the unemployment rate among young people was 21.3% in the month of June, a new record. And that's not all. According to the reports, China's GDP is expected to slow even further in the coming months because of the slack in the consumer demand and the collapse in demand for Chinese exports in other economies as their post-pandemic recoveries lose momentum.
The rebound on reopening has been much less than expected and much less than in many other countries, especially in the West. And so I do think that puts some pressure on the 5% growth target. And I think the Chinese authorities and indeed the market is sort of well aware of it, right? I suppose what's happening is that the authorities are becoming more accepting of a somewhat lower growth rate because China's potential growth rate is probably declining. And not least because the demographic transition has advanced rapidly. And because I think it has to be said, what's happening in China, partly by design, is sort of the opposite of what's happened in much of the rest of the world. In China, the lockdown was much more intensive. It was much more extensive, right? Because it lasted much longer and much more repeated. And there was much less government support in terms of fiscal transfers and much less in terms of monetary policy support as well. So I think, therefore, we're having, if you want to say, put it this way, a more sort of natural recovery after an extended period of lockdown, extended period of pressure on business, particularly small and medium-sized enterprises, small business, and on households. In China, they're probably, retaining excess savings and being more precautionary, more cautious in their behavior. So I think that helps to explain why the recovery so far has been less than expected. I would say, today's number was less than expected, but a lot of the kind of higher frequency growth data had been pointing in that direction. So maybe it wasn't such a surprise on the day. I think it's the accumulation of this kind of signal of weak economic recovery relative to earlier expectations of a Western-style rebound that has been taking place over a period of time. Looking out longer term, growth is probably going to be lower than it was. But of course, it's a much larger economy than it used to be in the days of near double-digit growth. So it's going to still be an important source of growth for the world economy, even as the growth rate slows down.
Right. It's that time of the show where we slip into a very short break. Let's have a quick look at the Nifty. Absolutely flat is where the gift Nifty is at. We'll take a short break. More on the other side, so stay tuned. Right, welcome back. You're watching Market Cafe on ET Now. Let's take a quick roundup of what Asian markets are up to in early trade. We did see US markets largely close in the green, which is definitely a positive. You also have US futures largely flat, so nothing majorly in the red. But let's quickly look at Asia. Shanghai down around 0.4% as we start the day today. We're also seeing a little bit of red on the Hang Seng as well, 1.9% lower, in fact, on the Hang Seng. So, sharply lower. The Kospi is down around 0.5% or thereabouts. You're also seeing red on the ASX 200, the Nikkei 0.5% higher, and the ASX 200 also in the red early on in trade, around 0.4% lower. So those are the kind of cues coming in from Asian markets. Nothing except positive on the Nikkei. All the others pretty much in the red. But the gift Nifty holding up smartly, absolutely flat, at least, before the start of early trade today. So that's where we're at, Ankita.
Welcome back. You're watching Market Cafe with me, Ankita Saxena, and with me is Harsh Saita. Let's move on to news coming in on the domestic front then. The two-day G20 finance ministers and the central bank governors met in Gandhinagar, co-chaired by Gujarat. Now, the RBI Governor Shaktikanta Das and Union Finance Minister Nirmala Sitharaman and my colleague Ankur Mishra is here with the roundup of what happened. Let's go across to Ankur.
Yes, all important finance and central bank governors of G20 meeting is underway currently at Gandhinagar, and as far as the issues which are getting discussed is the multi-development banks is something which is top of the agenda. Apart from that, there is also a discussion which is happening on the financing part, and as far as the agenda is concerned, there is also a concern on how the debt problem of the countries which cannot afford can be dealt with, and that is for the countries which are under the common framework. Apart from that, there is also a discussion and a concept note which needs to be prepared for crypto assets. In fact, a separate session is kept for the discussion on crypto assets, and this is something which under India's presidency, India has been trying to prepare a note on the same so that it can be circulated and finally it can be taken in the leaders summit which is set to happen later this year. So all these things are in the agenda of a G20 meeting which is currently underway at Gandhinagar. Now we need to wait and see on the final confirmation which comes by Finance Minister, who will be holding a press conference at the closing ceremony of G20 meeting.
I think that what digitization is doing for India, and it's the whole of digitization. Land records are digitized, identities are digitized. You can't just do digitization of lending without digitizing the infrastructure. What India has done over the last 15-20 years, it is digitizing the infrastructure, and that is enabling all these terrific applications to be built, which makes it easier for people to access services online. So I'm a big fan of it as a whole, economically, than I have been for a long time. The fact is the world economy is in a difficult place, right? It has outperformed what everybody thought, but it doesn't mean that it won't be more challenging. The IMF forecast, the World Bank forecasts are that the world will get a little challenging over the next year or so. But as I said in a speech this morning, forecast is not equal to destiny. We can change destiny, and that's what we should think about.
Right, and switching focus, we're moving on to Z. Z has established an interim committee of senior executives to take charge of operations. This decision comes as the company's managing director and chief executive, Puneet Goenka, faces a setback after failing to obtain relief from the Securities and Appellate Tribunal. Ankur filed this report yesterday. Ankur.
After all the legal hurdles which were faced by Z Entertainment and no relief which came from Securities Appellate Tribunal on the appeal of Puneet Goenka and Subhash Chandra, Z Entertainment has now decided that it will constitute a committee for day-to-day functions. Remember, SEBI's interim order had barred Puneet Goenka from holding any of the key managerial position in any of the listed company, and therefore now this constitution of committee has been done, keeping in line that order, since there was a no relief which was granted by Securities Appellate Tribunal. Now, as far as the proceedings are concerned, SAT had directed Puneet Goenka and Subhash Chandra to appear before SEBI, and the final order of SEBI will decide the fate of Puneet Goenka, whether or not he can be reinstated as MD or CEO, or the charges which were leveled by the regulator against the company has been found in the confirmatory order or not. But for now, Puneet Goenka has written a letter to employees, and in that he has said that, as I have always maintained, that the merger with Sony is in the interest of all the stakeholders, and that includes employees as well. He also mentioned the reason of writing this kind of note, that there should be clarity and transparency for employees, and for now he is seeking the legal help, and with the legal experts' help he will exercise all his legal rights. That is what he has mentioned in the letter which has been written to the employees.
And moving on then, staying with the news, Z Entertainment's MD Puneet Goenka on Monday wrote a letter to employees stating that the merger of Z Entertainment and Sony has reached an advanced stage of completion, and the issues faced by promoters with SEBI should not become a problem for the company. And he said, and I quote, "The important point to be focused upon is not what is happening to me, but on what is happening or should happen to a great company which we have built together over the last 30 years and more. The important point to be excited about is the fact that this company is all set to merge with the most prestigious global media and entertainment brand. This company is all set to merge with the most prestigious and global media and entertainment brand, and hence I write to you today that more as a colleague and as a team member of yours to make a humble request. Please do not let any tinge of negativity distract you from the set goals of this company.
Right, that was, of course, Z Entertainment. But let's quickly move on. Let's shift focus to the banking pack. We have IndusInd Bank declaring results today. We have HDFC Bank that posted a steady set of numbers for Q1 yesterday. Profit for the quarter has come in above estimates. It's gone up by around 30% on a year-on-year basis. But let's firstly talk about the top line. You're seeing net interest income, which went up a solid 21% year over year. We're also seeing other income, which grew on a lower base, which grew a very solid 45% year over year. OPEX went up roughly 34%, stayed elevated. That is the expectation, anticipation, and operating profit was not really dented on the back of that. Operating profit went up 22% year on year. In fact, saw a 1% jump even sequentially. In terms of provisioning came in lower than expected. Credit costs coming in lower than expected as well. 4,000 crore was the provisioning expectation. It's come in at 2,860 crore. So definitely lower, and therefore you saw a boost on the PAT, on the bottom line, 30% higher versus the 20% that we had penciled in. On the loan growth front, of course, positive is that the loan growth came in at 16%, deposit growth came in at 19%. And despite that, NIMs did not trim in a big way. So that's one of the other key positives to take away. The GNPA ratio saw a rise of around 5 basis points, absolutely marginal. The net NPA ratio largely flat, just 2 basis point rise there. So stable asset quality. Let's quickly go to that HDFC Bank con call, quickly take in what the management had to say.
Our results reflect consistency of delivery, diligently executed to result in continued momentum in deposit growth of 19% and retail deposit growth of 21.5%, gross advances growth of 20%, and net of IBPC growth of 16%. Profit after tax increased by 30%, delivering return on asset in the quarter of over 2% and return on equity of about 17.3%. Deposits from HDFC Limited, as it has got merged with the bank, will have an immediate impact to the CASA ratio because it is a time deposit that comes and adds to us, right? So it will have an impact. The 39% is a long-term average, and yes, that is the kind of how we are opening the distribution to get more customers, to get the more savings account, and reach to those small businesses and entities to get the current accounts also. Loan against share, loan against share, some of that has already come down, and to the extent that it qualifies in the bank, that is where we will continue to build and nurture. Otherwise, we'll have to run it down.
Right, that was of course the management of HDFC Bank. Let's quickly move on and understand what brokerages are saying about this result. JP Morgan continues to maintain an overweight on the counter, target price $2,000 a piece. What they're suggesting is asset quality remains solid. Retail deposit accretion has slowed, but that's not much of a concern. The merged entities gross loan book has grown well, and they believe that the bank can steadily compound earnings with low volatility. So that's a positive. Let's look at Morgan Stanley as well, maintaining an overweight, target price 21.10 a share. What they're suggesting is strong improvement in liquidity, and focus is going to shift on growth acceleration over the next year or so. You're seeing core operating profit growth strong at 16%. You're seeing sequential deposit growth moderation, but that reflects seasonality. Bernstein also maintains an outperform, target price 2300 a share. They believe that there are no merger related one-offs expected in the next quarter, so that's a positive. They don't change any target ranges for loan growth as well as ROA. They believe that the lack of a one-off or idiosyncratic reason to explain the weak QOQ deposit growth may be a bit of a concern. Let's quickly move on. We also have the likes of a Macquarie, target price 2110. They are suggesting that the PAT beat is driven by lower credit costs, and the lower credit cost is offset by higher OPEX. The lower deposit growth is on account of seasonality, not really a concern. Loan growth is driven by CRB, personal and home loans, and the merged entity ROA guidance remains unchanged, which is a positive. They believe that Investec also has a hold. This one is probably one of the few brokerages with a hold rating, target price 1750. They believe that advances growth will likely remain tepid. That's the concern that they have. Core PPOP to remain weak post the merger, and they believe that CASA and core retail LCR deposit growth to be the only likely offset to that. So all of the brokerages on HDFC Bank.
All right, then now moving on to another company that reported its quarter numbers, and the IT company LTIMindtree was the company that announced its Q1 results, and where the revenues were a slight miss, but the margins hold steady. Now, the revenue in constant currency terms grew by 0.1% sequentially. My colleague Anisha is here with all the number crunching. Take it away, Anisha.
Well, LTIMindtree reported a muted set of numbers, and I say that because on the top line, the constant currency growth came in at just 0.1%, and that compares with the street estimates of 0.6% growth. However, having said that, at least margins have been resilient. The company has been able to report a margin of 16.7%. That compares with the street expectation of around 16.8%, despite the leftover impact of merger costs coming in. On the bottom line, however, there was a bit of a miss on account of the top line being weaker. So the actual profits came in closer to 1,150 crores. We were working with a number which was closer to 1,200 crores. In terms of the other internals, the deal wins have been fairly steady at $1.4 billion. However, the headcount has fallen by almost 2% on a quarter-on-quarter basis, and this is the third or the fourth quarter that the company has been reporting a decline in terms of headcounts, and that tells you that there is that inherent weakness that the street is anticipating. In terms of the verticals as well, BFS actually declined sequentially, while high-tech and healthcare managed to grow. There was also a bit of weakness when it comes to retail and manufacturing. So those were the key things to watch out for, and even Europe, for that matter, declined a bit. So overall, a muted set coming in from LTIMindtree this time around. The top line was the biggest miss.
LTIMindtree is all about creating a bigger, better and bolder future for all our stakeholders. Our recent inclusion in Nifty 50, India's leading stock market index, is a testament to our unwavering commitment to shaping a brighter future for our stakeholders. We are pleased to report that our revenues came in at a healthy $1.06 billion, a growth of 8.2% in constant currency and 8.1% in dollar terms year over year, despite a challenging ongoing macroeconomic environment. The growth was driven by strong performance across our major industry verticals and geographies.
Right. Let's quickly switch focus. Pankaj Murarka, who's the CIO at Renaissance Investment Managers, believes that the worst is over for Indian IT companies. He also believes that it is a good time to invest in IT companies for the medium term. Let's listen in to his rationale on that one.
That the worst seems to be behind for IT services company, primarily for 2 or 3 reasons. One, from the time they peaked in late 21 and early 2022, over the last 18 months, valuation in the whole sector has moderated very significantly. You see large caps, the valuation have corrected about 20-25%, and the valuation correction in mid caps has been even more steeper, something like 30-35%. And now that the economy is holding back, there is a renewed confidence amongst clients where corporates are willing to commit money to projects and larger projects. So I think we are seeing some sort of a revival in that sense in order bookings for IT companies. So when you talk about results for TCS, I think what we clearly saw that while the results were somewhat muted or moderate in terms of revenue growth, but the TCV, the total contract value, was very strong at $10 billion plus. And we've seen similar trends with other IT companies also. So I think the last 12 months that we've seen some strong order bookings from these IT companies, this should start translating into better and stronger revenue growth for Indian IT services companies from the second half of this year. So my take is that the worst is behind for IT services sector, and stocks, and probably it's a good time to invest into these stocks from a medium-term perspective.
All right, then with that, it's time for us to step into a short break. You don't go anywhere. After the break, we get you all the stock-specific news.
Right, welcome back. You're watching Market Cafe on ET Now. Let's quickly move on to all the stocks that you need to watch out for in trade today. We have Ansh in the studio with us. Ansh, talk to us about all the stocks that are in news. Which should we keep our eyes out on?
Sure. So IDFC would be the first stock in focus for today's trading session, as Mr. Bipin Gemani has been appointed as the whole-time director and CFO of the company starting from 17th July. Apart from this, JK Tyre will also be in focus, as the manufacturing facility of company's subsidiary was temporarily stopped due to heavy rain in Uttarakhand. However, it has resumed its operations now. Gujarat Fluorochemicals will also be in focus, as a company's wholly owned subsidiary, Gujarat Fluorochemical FZE, has begun its commercial operations in Dubai yesterday. Maruti Suzuki has added acoustic vehicle alerting system to the electric models of Grand Vitara. The company has also made price changes in these variants starting from 4,000. Apart from this, Hinware Home Innovations will also be in focus, as Mr. Salil Kapoor has been appointed as the CEO of the company effective from today. Landmark Cars will also be in focus on the back of the business updates. Car sales business has registered a degrowth. Also, the total revenue for Q1 has fallen by around 9% to 936 crore. Infosys will also be in focus, as company has won a 2 billion AI automation development contract. Lastly, Tata Elxsi will be in focus on the back of the financial updates. Revenue of 850 crore has been reported, which is up by 1.4% on a quarter-on-quarter basis. However, PAT has fallen by 6.2% to 189 crore.
All right, Ansh, thank you so much for that. We will be watching out for all the stocks that you mentioned. Now, let's talk about the auto sector then. What is really driving the rally? My colleague Shrishti is here with all the details. Take it away, Shrishti.
Well, yes, auto sector is sitting at its record high level, and what we have seen is stocks like Tata Motors, M&M, Maruti Suzuki, all these two-wheeler companies have done fantastically well since the start of the year. So firstly, let's highlight what are some of the important factors that must have fueled this rally. First up is the FPI inflow. We have seen FPIs making a comeback in this particular sector, wherein the FPIs in holding in this sector has seen an uptick of 100 basis points to 6.5% now, and that's the highest level since 2020. The first half of calendar year has seen an inflow of $2.6 billion by the FPIs, and that's a very good amount. Coming to the earnings part, the Nifty earnings, auto earnings have seen an upgrade of 26% for FY23, and that's one of the biggest earnings upgrade we have seen in the last 5 years. And the star segment was definitely the passenger vehicle space, wherein FY23 has been a record one. Now let's talk about the valuations, because after such a stellar jump, what we are seeing is that the Nifty Auto Index is seen to be trading at an expensive valuation versus the 5-year average. At 22.7, 1-year forward multiple is what Nifty Auto is trading versus a 5-year average of 21.5 times, and a lot of stocks over there from the likes of M&M, Hero MotoCorp, Bajaj Auto, TVS Motors, as well as Escorts are seen to be following the suit. When it comes to some of the factors that investors must be ignoring, then probably the recent decline in the retail sales, especially in the passenger vehicle segment, is one such factor that we wish that probably they are ignoring. The average inventory in the passenger vehicle has seen an uptick to 45 to 49 days in the month of June versus an average of 30 to 35 days. Other than that, if we took a look at the two-wheeler segment, then the sales are still significantly below the peak of FY15. The commercial vehicle sales outlook also look mixed, and the electric two-wheeler segment is also not seeing a good uptick after the recent subsidy cuts. So all of these factors that must be playing for the Nifty Auto Index, but the valuation right now still looked a bit expensive.
Right, thanks so much for all of those insights, Srishti. Very quickly moving on, we have Vamakshi here who's going through all the brokerage notes. Talk to us through the key ones, Vamakshi.
Well, yes, let's first start off with Sheela Foam. The deal was announced with Golman, and in fact, we have several brokerages coming out with their opinion on the deal. We have Investec maintaining a buy call with a target price of 1,420, while Nuvama has maintained a hold call with a target price of 1,162. But largely, when we look at the brokerage commentary, it looks quite positive as far as this deal is concerned. The brokerages have highlighted that the deal is positive given the attractive valuation. The key important factor that we will have to focus on will be the revival in growth. They're seeing consolidation in this industry as a positive, and in fact they're seeing potential cost as well as synergy gains on the operational front for Sheela Foam. So on the back of that, a thumbs up coming in for Sheela Foam on the back of that deal. Other than that, we also have Havells in focus. We have a note coming in from UBS, and they have highlighted that structural growth is back into focus. They're seeing a $40 billion US dollars opportunity by FY28, and in fact they're expecting to see an earnings CAGR of almost 26%. There were concerns over the past 2 years, but they're all over now, and in fact capital allocation is expected to be return accretive. Valuation is expected to be the best choice to play consumer electricals, and in fact they believe that Havells will move up the growth as well as the profitability curve. So given all those positive factors, we have UBS in fact upgrading its rating on Havells from neutral to buy. They've also gone ahead and hiked the target price from 1,360 to 1,900 per share. Other than that, lastly, we'll watch out for GSW Energy. We have a note coming in from CLSA. Now, weak merchant markets as well as wind hydrogeneration is expected to be hurt. In fact, the renewable energy share is seen accelerating, but the returns may be lower. So on the back of those negative factors, we do have CLSA maintaining a sell rating, but nevertheless, they've hiked the target price slightly from 215 to 234 per share.
For that, Vamakshi. Also, IndusInd Bank will be in focus, all set to report its Q1 numbers as well. We saw HDFC Bank report a solid set yesterday, and IndusInd Bank is supposed to mirror that today as well. You're seeing NII growth roughly in the range of that 18% mark. You're seeing operating profit go up by roughly 12% or thereabouts. 3850 crore is where that operating profit is expected to come in at. Credit costs are expected to remain benign. Your provisioning is expected to remain largely flat sequentially. 1,030 crore is where the provisioning was in Q4 of FY23, expected at around 1,000 crore odd even in this quarter. So you're continuing to expect that very benign credit cycle to aid profitability. PAT is expected to go up by a solid 29% year on year. It's expected to come in around that 2,100 crore mark. Let's also look at the way in which MFI will move, because that commentary will come through today. Whether growth is coming back, whether recoveries are doing well, whether businesses are looking good or not. So trends around that. Of course, with regard to the balance sheet itself, you're seeing good growth on both sides. We did see those numbers, 21% growth on the advances side coming in for IndusInd. We also saw a solid 14.5+% growth on the deposit front. So largely, hopefully, a stable quarter. That's the large expectation from IndusInd Bank.
And well, moving on then, as per data coming through in a research report by GfK, in the first 5 months of the calendar year, while the overall TV category is in the consumer products market grew by 13% on a year-on-year basis, the TV sets that are 65 inches and above grew by 37%. Now, these big screens now contribute 12% of the overall TV market in the country compared to 5% during the pre-COVID times. My colleague Samir has more on this. Let's go across to him.
When it comes to the TV screen size, bada hai to behtar hai. This philosophy is dominating the TV sales trend in the country. If we go by numbers, in the initial 5 months of this calendar year, the overall TV sales grew by around 30%, but the large size TV, which is 65 inch and above, it grew by more than 37%. The consumers are willing to pay a hefty amount, even up to rupees 75 lakh for buying these large size TV. But what is the trend and what has actually the new buying pattern which is emerging in India? The experts suggest that post-COVID, there is a very interesting trend that has came up, that is setting up a theater-like experience in home and enjoying you're watching movie or even watching cricket matches. Secondly, the entry of affordable brands in the TV industry that has also pushed the TV sales of large size TV in the country. And not just this, there is another interesting trend that has come up, and that is to improve the CIBIL score. It has also been seen that people, they usually buy large size TV and then they pay regular installment, and that helps them to improve their CIBIL score. So these are a couple of factors which is actually driving the sales of large size TV. That means 65-inch and above TV in the country. And going by the trend, the expert also suggests that seeking the upcoming festive season or even the cricket World Cup that is to be there in the second half of this year, that will further drive the sales of these TV in the country.
Right, thanks so much for that. Changing trends playing out. Let's quickly also go to Saurabh Mukherjee from Marcellus Investment Managers. He says that Accenture and TCS's order book still looks strong. We're in the thick of IT earnings. He also comments on the role of AI and what AI could play for the entire IT services pack. Listen in to some of his views.
First, let's look at the numbers, whether it's TCS, whether it is Accenture. Their order books are growing at a rapid rate, right? I think TCS in total is 17 or 18%, $10 billion swelling of the order book, which I think translates into 17-18% growth in order book, right? So order book growth hasn't weakened. Now, why hasn't order book growth weakened? Firstly, because AI is not a negative for IT services company. I just find it astounding as to where this motion arises. That AI is less work. AI means more work for IT services companies. AI also means that the testing element in a bespoke software project potentially can be done with lesser labor. But that's a saving for TCS. It's not a reduced amount of workload for TCS or indeed for Infosys. So I don't understand this point of view why AI is a negative. To my mind, AI is an even bigger positive. If you're going into software economic growth, you're a Western company going into software economic growth, I presume you have to cut your costs further. One of the most straightforward ways to cut your costs further is move more work to India, automate further. To automate further, you need to hire firms like TCS. So every which way you look at it, the current situation, both in terms of the structural uptrend in IT sophistication and the near-term recessionary clouds in the Western world, both of them are pretty positive. And the result of that is the order book, the punchy order book numbers that the Indian IT services firms are reporting. TCS and Accenture, given that they're the best in class for the West and for India, are obviously at the forefront of that. Main addition we made is around 3 months ago, we bought Metropolis Healthcare in our small cap portfolio. We believe that the whole funding boom, the private equity and venture capital pumped in money into startup lab companies, that I think is behind us. And Dr. Lal and Metropolis therefore should be well placed to benefit from the hike in prices again in the path lab sector. Barring that, we haven't made any massive investments. We're contemplating a couple more changes to two of our larger portfolios, but we haven't made any massive changes. Our portfolio churn is very low, 10 to 15%. We stay invested in companies for 8-9 years.
All right, moving on then. All eyes will be on Sheela Foam today after the company announced 2 big-ticket acquisitions as part of their mattress and furniture industry foray. Now, Sheela Foam has acquired majority stake in companies mattress making, Kurlon and online furniture rental for Lenco. My colleague Sharad is here with the deal contours. Take it away, Sharad.
Important development coming in as Sheela Foam has announced to acquire almost 95% stake in Kurlon mattresses, and of course do remember that it will be an all cash deal of almost 2,150 crore rupees. Now apart from this also, the acquisition is expected to be completed by November 30th this year, and looking at the deal specifics, the price to sales ratio for FY22 numbers stands at 2.7 times, while for Sheela Foam on FY23 numbers it stands at almost 4 times. Deal looks value accretive for Sheela Foam, and also it is a news break confirmed for ET Now News, and we had earlier pointed out on December 20th about this news of Sheela Foam expected to acquire the entirety of Kurlon mattress. Now of course the cash balance stands at almost roughly 42 crore rupees for Sheela Foam, so we are expecting the acquisition to happen via a mix of debt as well as equity, and the market share of the combined entity that is expected to be 50% when it comes in the organized mattress space. And the Indian mattress industry is valued in the organized market in the range of 15 to 17,000 crore rupees. Now, we did a channel check on the valuations, and what the earlier reports were suggested, they were coming in the range of roughly almost 2,700 to 3,300 crore plus, while in the unlisted market itself the range was coming between 2,300 to 2,500 crore rupees, but the deal happened at 2,150 crore rupees. But what does this mean for the industry? This means consolidation is expected to happen, as the two largest players have actually become a bigger entity, and more bargaining power would be there against the dealers. And also the important thing is the distribution network. That is what the Kurlon will be getting, especially on the northern India and the southern India. So it becomes a pan-India. Overall, if you see the market share, that is itself going to be roughly 16% when it comes to the overall mattress size. And the second acquisition has also been announced, so where the company will be acquiring 35% stake in Furlenco for a value of almost 300 crore rupees in an all-cash deal. Apart from this, the company will be foraying into the online as well as the furniture rental market.
Extremely interesting developments in the space. Sheela Foam, of course, acquiring both Kurlon as well as Furlenco. But with that, we're completely out of time on this edition of Market Cafe. We have the GIFT Nifty indicating a slightly lower start, flat, but slight negative bias coming through. And with that, we leave you the market to take all the action forward.
बिजनेस लोन्स बोले तो सिर्फ लेंडिंग कार्ड और विक बोले तो